especially real estate, is not a area of activity where you need to know everything before you start. You don't. My advice is to get some, the emphasis on some education, and and then take a step because you're going to learn from the other people that are doing the same thing you are when you get around them. I highly recommend getting involved with whatever your local um, uh, real estate landlord group is, an investor group of some sort, and just get around other people that have done what you've done or are doing what you're doing. And you will learn what you need to learn to go to the next step just by doing. Don't try to learn it all ahead of time before you take your first step.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. So what happens when a kid with a paper route becomes a DJ, builds a rental portfolio, flips over 100 homes, and then ends up lending to the next generation of investors? In today's episode, we dive into how Joel Miller built a real estate empire without giving up his passion for entertaining, and how you can build a wealth without burning out. We'll cover private lending, avoiding rookie tax mistakes, and why real estate might be the most forgiving asset class out there. Joel Miller is the author of Build Real Estate Wealth, Enjoy the Journey. He's been investing since 1978, he's flipped over 100 homes, and now lends to other investors through his firm, Just Lending. With background in accounting and decades of mobile DJ, Joel brings a unique perspective to wealth building and a whole lot of wisdom for our listeners today. Here we go. Hey, Joel, welcome to the show. Welcome to, I would say what day it is, but I have no idea because I live my life and people say, how was your weekend? And I say, it was a weekend? I don't know. I live a life of passion, and as do you. I'm so excited to share your journey here with the listeners today. How does it feel to be Joel today?
Oh, it feels good, Brett. I'm glad you and I are finally getting together after a couple times when we weren't able to, connect on appointments. But this is going to be good because I realized that like my book is very much in tune with what you have told me is your audience. So.
Yeah. So for the listeners out there today, we're going to touch on it a lot. But first of all, let's learn a little bit more about Joel. You've been investing in real estate since the late 70s. What drew you to real estate in the first place?
Well, that's a story I'd be happy to tell you because it's a very distinct thing. There were two actually very distinct things that happened in junior high that set me down the paths of my life. And number one was some investor built 4 4-unit apartment buildings on the edge of our subdivision. And I got all those tenants on my paper route. And it was kind of different because we all lived with our parents in single family homes that they owned. And this whole rental thing was a little different. And, they built them at the edge of the subdivision where the vacant lots were available, and it was different, So I have a distinct memory actually in about 8th grade of doing the math on what it's like to own rental properties, whatever rudimentary understanding I could have at the time, as far as just knowing that those people didn't own those places. They paid money to live there and somebody made a profit off of that. The other thing that happened was an older kid in the neighborhood built a pirate radio station in his basement. Pirate is an unlicensed, illegal radio station. It was an FM station, and he had the flagpole was the antenna in the backyard, and I got to hang out there. And that's when I decided I wanted to be a disc jockey. And so I actually did work in radio in high school, went to college where they had a good, radio club there, and studied accounting. I wanted to get a 4-year degree in accounting because you can use that in whatever you are headed into. So about halfway through college, I got a job at the big radio station in my hometown and came back and finished the other 2 years locally in college to get my degree. And a few weeks before I graduated in 1976, I went from being the part-time weekend guy to full-time. And that meant that I could take the calls from the kids from the high schools that wanted the DJs to come out to do the record hop or sock hop or whatever.
Mm-hmm.
And so I got started on that and pioneered the mobile DJ business in this part of the country. And for the listeners, I'm in Erie, Pennsylvania, about halfway between Cleveland and Buffalo, north of Pittsburgh, right along Lake Erie. And so it wasn't very long after that, in January of 78, I bought my first rental property. And that continued to grow. I did start an accounting practice, but I sold that after several years because something had to give, Brett. Couldn't do everything, So just built the rental property and the mobile DJ business simultaneously. I did 35 years as a mobile DJ, 5,051 appearances before retiring in 2011. And that's part of the premise of my book, which is called Build Real Estate Wealth. Enjoy the journey of rental property investment, which is that real estate doesn't have to be an either or thing. You can choose to just add real estate on to whatever it is that you want to hold on to. Like I wanted to be an entertainer. I didn't want to give that up, and people have professions or jobs or hobbies that they don't want to let go of. And they also want to build income and build retirement. So that's why rental property is a good match for that. And that's a large part of the premise of my book, as far as who should read it.
Yeah. So I actually had a paper route as well too, and I do they still have paper routes? I mean,
not around here.
Still have these
from
things
having
these days?
little kids as carriers to having adults that were taking things around, particularly in rural, to now it's mailed to us. If you
digital, yeah.
Mail.
And the other interesting thing, so is entertaining. Being an accountant or having an accounting background is perfect for being able to speak business in real estate, especially. But it's entertaining that you are an outgoing entertainer, right? Someone who makes appearances and have a accounting background. That's kind of unique to where those two things don't usually go together, right?
It was like two personalities, but I've always used my same name, my real name, as an author, as a radio DJ, as a mobile DJ. It was just like, it's like Alice Cooper. Are you talking to Alice or are you talking to Alice? So, but I should add that after a number of years, I started flipping houses, and since 1991, I have flipped over 100 houses. And then in 2018, got into something really cool, which is hard money lending, where I am lending to the other investors in our area for their projects, either flips or keeper rental properties that buy and hold. And it gives me great pleasure to be a part of the equation for the other investors' journeys that are a little earlier on in their real estate careers. And
and you can share some of that experience with them as you're underwriting their deals too. And
that's part of what you get when you borrow money from me is I won't lend to you unless we walk the property inside and out. And I'll be honest with you, sometimes at the end of the visit, they're absolutely sure they don't want to buy that property, because it's just something I asked them, or if they considered it or whatever. And I make myself available during the project if they want it for my input on what they should do in a certain room, or with certain products, or whatever they want to talk about.
You said your first flip was in 1991. How did the flipping landscape look back then compared to now?
Back then, I could go to an auction, and sometimes I was the only one there. I mean, I bought a bunch of properties for $1 over the minimum bid. Either sheriff's sale or marshal sale. Now it's crazy money. After all first of all, we didn't even know it was flipping. Called it quick turn.
Yeah.
Flipping didn't come about as a real estate term until many years later when the TV shows started.
HGTV.
Yeah. And that's what really spurred the whole, geez, anybody can do this kind of thing. And
then there's YouTube.
Yeah, and you end up with far more people at the auctions now.
Yeah,
for the most part, So yes, it was a little different landscape.
Yes, for the listeners that may not have experienced the auction, Joy, What happens when a property goes into foreclosure? Somebody has taken out a mortgage and there's a lien on the property that basically is there to keep the lender whole, to make the lender whole. And these municipalities be a little different in different municipalities. They used to be on the steps, right? Some of them are in rooms where they used to, the lender would say, hey, I need this much money. And Joel said that he could, have that dollar above. Most of the time is because there's nobody else in the room. When you make that dollar above, the thing is now, whether it's a tax auction or a foreclosure auction, the speed of information, how easy it is to make a bid, and it's just literally it almost reminds me of a casino. Like when you pull the slot machine now, when those bids are coming in, it's so competitive.
Yeah, that's right.
It's funny.
If the property sells for more than what the lender is owed, then that's when the person who's losing the property would get the extra money. But yeah, it's a casino. That's interesting. I've never heard anybody call a casino or use the term casino to describe the current foreclosure auction landscape, but that might be true.
Yeah. Ding, 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 ding. I just hear it in my mind. Now let's talk about mindset here. You talk about mindset that investors need. What's the difference between having money and building wealth?
Well, I have a whole chapter in the book that's called The Impact of Wealth, and it discusses the difference between riches and wealth. It's kind of like the difference between knowledge and wisdom. Knowledge is simply knowing the facts, and wisdom is being able to use the facts to make good decisions and do good. And with riches, that's basically having the cash, but not necessarily happiness or whatever. The wealth is when you know what to do with your cash to make good decisions and do good in your community. You could have little and feel wealthy because you are content with what you have and you're making good decisions with your material things that you do have. And you all know miserable people that have a lot of money, So that's kind of the difference. I'm known in this area because I teach a lot of landlord 101 classes, do seminars and masterminds and stuff like that. I'm known for saying what I'm going to tell you right now, because it comes up when sometimes people ask me privately about something that they have a dilemma with, or I might be saying this in front of the group. And that is this: if I had a choice between losing all my money and losing all of my relationships, I would lose all my money in a heartbeat, because my relationships will help me get my money back. And if I've got all the money and no relationships to enjoy it with, that's pretty empty. So my advice is, don't make a withdrawal from a relationship just to make a deposit in your bank account.
Interesting. Very well said. What mental blocks do you see in new investors, and how do you help them break through?
I think the mental blocks are maybe more like preconceptions. Sometimes they have a preconception that things are easier in this business than it is, and they expect too much and nothing happens or not enough happens. And so they drop out without really experiencing any success. And then the opposite is thinking that they'd never be able to learn how to do it, that it's too hard, and they need to think about it too much, and they end up with the paralysis of analysis, and they just think like, oh my gosh, you know what? I need just to go to one more seminar. I need to read this one more book, and I hope it's my book, Build Real Estate Wealth. And or they just need to get that coach or whatever, go to the boot camp, and they never end up taking action, or they take a little bit of action. But the thing is that a little bit of action, even though you think you're ready, is still not good unless you have commitment to follow through on the action you've taken, and commitment to take the next step. And I point out in my book that, especially real estate, is not a area of activity where you need to know everything before you start. You don't. My advice is to get some, the emphasis on some education, and and then take a step, because you're going to learn from the other people that are doing the same thing you are when you get around them. I highly recommend getting involved with whatever your local um, uh, real estate landlord group is, an investor group of some sort, and just get around other people that have done what you've done or are doing what you're doing. And you will learn what you need to learn to go to the next step just by doing. Don't try to learn it all ahead of time before you take your first step.
So expanding your associations is a huge piece of this, making sure you've got the right people around you. And you had mentioned, losing money or relationships, and it's lose money all day, because the relationships is how you leverage those relationships in order to make that money back. So, it's that law of averages, surround yourself with the right people. It all comes into play. And that's in the real estate world. The real estate world, I've heard many times, is called the business of relationships. But the rental real estate business, what is your nutshell description for the rental real estate business?
I'll give you that here, Brett. First of all, we say that real estate is ideal, IDEAL, because you get income, you get depreciation, you get equity growth, from the mortgage being paid down, from the money that comes in from the tenants. A is appreciation, meaning just the properties grow in value over time, and L is leverage. We all know this business runs on OPM, other people's money. But in a nutshell, I'll tell you what it is. It's find a way to acquire property that other people will use. Okay. Let the people who use it buy it for you with their payments, which are greater than your expenses. Put up with minor irritations from the people and the maintenance issues along the way while you enjoy the cash flow and the equity growth. And 4 is repeat steps 1 through 3.
Again and again.
That's really it in a nutshell.
Yeah.
Just let somebody use something you buy and pay you more money than it costs you to own it.
Yeah, interesting. And finding the assets that people want, where they want it, how they can use it. And you mentioned these minor headaches, right? These minor hiccups with the people that are in there, and we can minimize those by screening or having the right property manager. What best practices do you recommend for tenant screening in property management?
Well, first of all, I want to point out that the tenant selection actually begins not when you get a phone call from somebody that's inquiring about a rental. It starts when you are thinking about the possibility of maybe perhaps buying some rental property. In other words, every decision that you make after you think about buying property slowly narrows the universe of the possible tenants that you would have. For example, your location, are you buying around the world, or are you buying, on the other side of town? Obviously that just eliminated a whole lot of people. And the type of property it is, the condition that the property is in, of course, the neighborhood, and how you prepare the property for showing it to somebody. All those things are gradually narrowing down who will rent this. And then you finally come into direct contact with a potential tenant through your tenant selection process, which the last part of which would include whatever advertising or outreach you are doing to get the possible universe of people to call you in the first place. But then once, let's say it's a case where you advertise to get people to call you so you can talk to them and decide whether you want to show them the apartment. Let's say that that's the process. It's pretty far down the line where you first come in direct contact with a live person. And that is where I would say tenant screening starts, because that would be the point at which you would be able to ask them specific questions as to whether you would want to have them as tenants in your property. So I always point out that your success or happiness in the rental property business is directly uh, hinging on your ability to select the tenants, whether it's you or you're selecting a property manager and they are selecting the tenants. There's got to be, some criteria there that are met, and some skill in determining whether the people you're evaluating are actually meeting your criteria or hiding something from you or whatever. And so I always point that out that's the biggest skill you need to learn. You could be good at finding property, financing property, fixing property, maintaining property, whatever. You can be good at all that, taking care of your back office. If you're not good, or you don't have somebody hired that's good at selecting the actual people that are going to use that property, occupy something that's worth tens of thousands, maybe even millions of dollars for an extended period of time without your direct supervision. If you don't get that down, you're not going to have a good time, in this business. So that's really paramount to a success, I believe, in the rental property business.
Yeah, and your book too, I think it's called the subtitle, "Enjoy the Journey." That really jumps out to me because yes, the tenant piece is huge. The property management piece is huge because it's not all sunshine and rainbows, and we just need these systems and processes and people that allow us to stick it out because real estate loves time, right?
Yeah, you can make mistakes, and time can heal the wound, with real estate, more than just about any other investment I can think of, because the assets are typically appreciating.
Yeah. And what the other ways, on top of tenant screening and having the right systems, process, people, is the way that we structure the entities for these assets, for these investments. Tell me a little bit about how you structure your entities for investing and why.
Well, I think that whether you're using a limited partnership, which is what much of my property is held in, limited partnership with, actually, my wife and myself are also the limited partners, or whether you're using an LLC or a corporation, subchapter S corporation, whatever you're doing, first of all, have sufficient legal help to have you get that set up. But the purpose of that is to isolate your liability, so that if a liability came up from a property that was owned within the entity, the coverage for that liability would come only from the assets and the insurance that are within that entity, and not spread to your personal assets. Mm-hmm. That's in case anybody was wondering, like, well, start an LLC. I guess I'm just supposed to do that, and you're not even understanding why. That's why, is so that you isolate your liability, and that also speaks to not having too many assets in one LLC, for example. Mm-hmm. You might have different groups of property. I also recommend that you don't flip properties in the same LLC that you own rentals. Mm-hmm. Keep your long-term rentals separate. So that because there's different scenarios that can create liability in a rental property versus a flip. You might have a tenant, win a case against you, and if there's a very valuable flip house in there, it's gone, and vice versa.
Yep. And so you say you're a private lender as well too, PML, private money lending. Mm-hmm. Is that done in a separate entity, or is there less?
Yeah, we don't lend in any. I have a separate company. It's called Just Lending, mm-hmm. That does all of the hard money loans, in addition to a Roth IRA, which I might point out, a lot of people don't realize that if you have an IRA custodian that specializes in non-traditional assets, you can own and operate rental property. You can do flips inside the IRA, and you can lend money. Mm-hmm. You can do almost anything in an IRA that you can do outside of an IRA, with the exception of basically the best description of what you can't do in an IRA is you can't own collectibles. Hmm. To just broadly state in other words, you can't be trading collectible things like gold and coins and furs or whatever.
Yeah,
You
maybe
can't do that.
leaning on
So
the enjoy. You can't enjoy the amenities of the investment. I think maybe part of that structure. I don't know. I mean,
yeah,
we have Roth IRA. We have self-directed. I've helped so many other investors in the coming to brainstorm a deal. Hey, I've got this going on. Well, do you have investors that have standard IRAs, Roth IRAs? I mean, finding the right custodian is huge. And, we work with a couple of different companies that help walk you through that path and do it in a way that mitigates the risk so it's being done right. Because you can take $50 or whatever it may be and go do this stuff yourself, set up the LLC. But the jumping through the hoops and hitting the checks and balances is having the right people at the table. Right.
right.
So
Yeah.
sorry, go ahead. Go ahead, Joe.
Well, I was just going to say that people should also know that it's completely possible to remove the assets in your traditional or Roth IRA that you have at a traditional brokerage house with them as the custodian and move that without you even touching it. It would go right from first custodian to a new custodian that specializes in non-traditional assets.
And it will not be a taxable event.
There's no penalty.
Yep, exactly. So in the private lending, what do you look for in a deal? So if there are listeners out there who may be considering private lending or borrowing from other people, what are some standouts when you're looking at a deal to say, hey, I will lend to you on this deal?
Well, it's mainly built on relationships and my knowledge of the assets that the property that they want to borrow against. I'm not lending money. In my case, I don't lend money that is secured by any sort of property that I wouldn't know what to do with if I, by chance, had to get it back in foreclosure. And so consequently, really, the other investors are not approaching me to lend them money on any sort of a project that I hadn't tackled in a similar manner, in my own investing. And I'm investing or lending on one of two situations. Either an investor is borrowing the money to buy and or rehab a single family home that they're going to sell to a third party, in which case we get paid off whenever they sell the house, and that's called flip. Or lending money to buy and or rehab a keeper rental property that they need to stabilize, either by doing a rehab perhaps, or raising the rents, getting different tenants in there, to get it to the point where a bank would be interested in giving them long-term permanent financing, in which case we get paid off at the time of the closing for the refi. So that's the beauty of it all, is the lack of an underwriting process that you would experience with a bank that might look at the deal for a couple of months and then say, you know what, we actually can't do this deal with you, or we can't give you the same terms that we told you about whenever we took your application fee 2 months ago. With private money, typically, I walk the property. If somebody calls me up and we talk about it over the phone, if it's worthwhile, we walk the property inside and out, and then just I agree right on the spot or not, to make the loan, and then just go back to the office and send them an email with the loan terms that they reply they agree to. Then it is sent to the attorneys to do their thing, and we have all the documentation that you would expect for a bank, a note and mortgage, I'm in mortgage state, and personal guarantee, and I haven't signed a deed in lieu of foreclosure, which is held in escrow by the attorneys in case this all goes sour. We just record the deed instead of going through foreclosure. But to answer your question more specifically, it's a relationship. A lot of times, I pretty much require the people that borrow from me to be a member of the local investors association. It's the Apartment Association of Northwestern PA. I happen to be the VP of that. I'm a long-serving past president and on the board for many, many, many years. And so I need to see you coming to the meetings and taking some education. I teach the landlord one-on-one class, so I often require, especially somebody that's going to be involved in rentals, that they take that class, preferably one of the times that I'm teaching it. And, it's pretty much on a handshake. So you, as an investor who wants to use private money, should be involved with the professional organization in somehow, so you can find out who the private money lenders are and let them see what you're doing.
Mm-hmm.
You know, it is not, you're not going to go online and find an application form for a private money lender that you've never met and expect to get any money.
Yeah.
The further away they are from where you live and operate, the more a private lender will feel like a bank. Because they're not in your community, they're not walking the property, so they're trying to make up for that with all kinds of documentation on you and the property and so on, and limitations on the LTV. I'll loan 100% LTV and all the rehab costs. Of course, the rehab costs are given out in draws as you work your way through, but as far as the property itself, you asked about what the requirements are. It just has to make sense as far as how much you're paying for it, how much you're putting into it, and what it's going to be worth when you're done.
You mentioned bank financing there, separate of PML. I don't know if you go any type of credit check or anything when you're screening a person for a private loan, but banks do. And as a real estate investor, I do my best to leverage as many tax benefits as possible. But what that does is it creates a challenge for me when I'm getting a loan from a bank, because they want to see cash flow. They want to see, your debt to income ratio, all of this stuff, so that the loans can be sold to Fannie Mae, Freddie Mac, that kind of stuff. How do you prepare financials to look attractive to lenders?
Well, I think what you might be alluding to is you're taking advantage of the perfectly legal part of the tax law regarding accelerated depreciation, for example, where more depreciation is taken in the early years of owning a property than you would get if you were just doing a straight line, or in other words, an even amount of depreciation the entire time you have it. Okay, there's some advantages to that because it does save you money, because it saves you taxes. But where I see a lot of the guys get in trouble that are operating rental properties, or even if they're doing flips, is they're making the huge mistake of writing off as current expenses the expenditures that should be capitalized. They should be added to the cost basis, in other words, the purchase price of the property, and not expensed. You could have the same guy who was like preparing a new rental property that he bought that was vacant, and writing off all of the expenses along the way, and then finally just starting to rent it out. And a different guy, or the same guy doing that, versus if he capitalized, just simply didn't take current expenses and added it to the cost basis. Same guy, same amount of money out the door, same property, same result, ending up with a rehabbed rental. And in one case, the bank will say, you don't make any money. I can't lend you any money. And in the other case, the bank says, wow, you look great. You're making money.
Yeah.
It's because you haven't written off all those expenses that you should not have written off. For example, the electric bill, while you're rehabbing a property, is capitalized until the day that property becomes a rental property. And from then on, if there's an electric bill that's associated with the property, that's a current expense. Same with like property taxes and repairs and so on. It's a lot of people don't understand it, so they get themselves in trouble. So a little further answer to that question is my biggest recommendation regarding preparing financial statements to look good to bankers is to not try to shove all your investment information onto the PFS, the personal financial statement, the form that they give you from the bank. If it has a section on there for rental property income, don't use it. I mean, that's for if like somebody owns some rental property in their own name and they only had a couple of properties, But if you have a rental property operation going, here's my recommendation. Make a separate statement of cash flow and also balance sheet. In other words, the value of the asset minus the liabilities leaves your equity. Make separate statements for each entity. It doesn't have to be for each property, but for each entity and each property within the entity, if you want to separate them. and transfer the bottom lines only from those statements onto the forms on the banker's personal financial statement. In other words, on the front page where it's asking for income from rentals, you don't enter anything there. Put it in one of the blank lines where you write in total net cash flow from the cash flow statements attached. Assuming they're all from rentals, you might have another line of business and you would not jam that onto the same line. You'd use one of the other blank lines and, total net income from my retail store, whatever. And the same with the net capital. Take the bottom line, the net worth of each of the different entities, and add them together and put them on one line on the balance sheet on the front page of the personal financial statement. That you say net capital from the 6 entities statements attached, whatever. Because you got to remember, people looking at these things, other than your branch manager, your bank, they're like 20 and 30-year-old people working in the underwriting department that are making decisions on your financial future who have absolutely no idea what your business operation is actually doing. Mm-hmm. And the clearer you can make it on the financial statement, and the easier to read you can make it in your best handwriting. And after all, some banks offer an online version, but they also are mainly just giving you the form to fill out, by hand. The clearer you can make it, and the less clutter, and the most understandable that you can make it, the better chance you have of getting your application approved.
Yeah, I like that. Keeping it simple with attached additional information, really easy. Right. Tons of stuff to unpack there. But I think kind of summing this experience up, what's one thing a high-earning professional should do today if they want to build wealth through real estate?
Well, first of all, buy my book. Mm-hmm. Because don't go into it unless you get some sort of knowledge. Now, I would make the assumption that in your question that somebody that has money and they haven't studied real estate at all. You need to get some education, even if you are going to determine that you're going to be hiring contractors and you're going to be hiring property managers and so on, because you need to understand how the business works. And my book goes from, having your mindset right to forming an entity, all through the acquisition and management of property and tenants and getting rid of property, selling property and so on, and wraps up with philosophical things like we talked about earlier, difference between riches and wealth, and a lot of best practices for business and life in general. And that makes it a little larger than a lot of books in the genre, but I have it set up for busy people, like a lot of your listeners, that you can just read. I have a whole lot of words and sentences and paragraphs in there that are in bold type, and you can just read from bold type to bold type to bold type, skipping through the content of the book and get the whole idea of what's going on. And if you feel you want to learn more, just stop and read all the words.
Mm-hmm. Where can listeners learn more or grab a copy of your book?
Well, the best place is to go to the website that's dedicated to the book. It's joelmillerbooks.com, JoelMillerbooks.com. And right on the home page of that, you can click on a button that'll show you the entire table of contents. And these are the subjects that need to be covered from A to Z if you're thinking about the possibility of getting into rental property. Or, even looking for, you have an established portfolio and you're looking for something to supercharge your existing portfolio and get some sort of game-changing information. You can find it in there. There's another button on the homepage where you can see some sample content, 2 or 3 of the meatiest paragraphs from every single chapter in the book. And people can follow me on Facebook, Instagram, X, and LinkedIn. They can just find me on those platforms if they want to see my posts and so on.
Wonderful. And that's Joel Miller Books, joelmillerbooks.com. We'll have that in the show description. And wow, so much here through the mobile DJ period into the real estate world. And a fun story, even how you met your wife was through real estate. We chatted about that before we got started here.
Yeah, I just met her because she was working in a real estate office in the building that I was managing.
So, man, what has real estate given to you, Joel? And
yeah, I'll tell you what, the backstory is that building was an office building. That was the absolute worst real estate investment I ever made. It would, by far. Yeah, I had that like a couple of months after I bought in to be the new managing partner with two of the other partners remaining. The two largest tenants, one had 51%, one had like 26% of the building went bankrupt.
Oh, wow.
So I spent 10 years putting out fires in that building.
Oh, wow.
And in the end of that time, I gave my interest to the other two partners. I gave it to them.
Oh, wow.
But I got my wife out of it at the end.
Wow.
And so that was the backstory on that. But yeah, real estate can be very forgiving. You know.
The dividend that stays with you forever. That's an awesome return for that investment. Thank you for investing your time with us here today and sharing your experience so much here. To the listeners out there, grab that book. It's joelmillerbooks.com. Build Real Estate Wealth. Enjoy the journey. That's what I want to do. Enjoy the journey of rental property investment. Thank you.
You know Ron LeGrand? You know who Ron LeGrand is?
No.
He's like the guru to the gurus, like the guru to the gurus that are out there teaching classes and all that. Okay, Ron is in his 70s, has been at this for a long time. He reviewed the book, and his quote was, "I wish I would have had his book when I was getting started."
Mm-hmm. That's awesome.
So,
that's awesome. Well, the listeners can, and thank you for that, Joel. Thank you for your day. Hey, enjoy the rest of your day.
Thank you very much, Brett. Appreciate it. My pleasure.
What a ride. From a teenage paperboy in Erie, Pennsylvania, to a seasoned investor with over 100 flips and a mobile DJ legacy of over 5,000 shows, Joel Miller is proof that real estate can align with your lifestyle, not the other way around. He reminded us, his reminder to enjoy the journey is more than just a book title. It's a mindset. Whether you're balancing medicine and investing or just starting your portfolio, remember, you don't need to know everything to take the first step. Want more? Grab his book, Build Real Estate Wealth, Enjoy the Journey at joelmillerbooks.com and check out the sample chapters. As always, you found value today? Share the episode with a colleague or friend and keep designing a life you don't need to vacation from. Catch you on the next one.
This episode is powered by Crescent Tech. If you are looking for a CRM built for real estate investors, discover Streamline REI by Crescent Tech. Simplify, automate, close faster.